It's a little hard to say. Maybe 60%, 2/3, something like that. We took a bunch of old stuff and said, "Does this hold up? Are there experiments? We run them again. We let the reader run them.
Right.
The stuff with data, we say, is it true out of sample?" There had been a chapter about the equity premium puzzle. Equity premium is exactly what it was over the first 40 years. So everything's the same.
When I look at it now, and I had an extensive interview with Christopher Waller the other day, with his work on game theory at Washington State in a very unconventional way. Is rational economics and believing in a perfect individual, a perfect firm, a perfect society, is it in retreat right now?
Yes. I mean, no one's waving a white flag. I've always said I've never changed anybody's mind, but I've corrupted a lot of young people. So the young people, including my co-author, Alex Emis, don't think it's realistic to build models about people that act like supercomputers. That you don't know anybody like that.
Yeah, and the humility here, which our generation didn't have, and Isabel Lee, I mean this with all affection, Isabel Lee's generation has enjoyed 3 once-in-a-lifetime events over the space of 15, 20 years. Isabel Lee with the laureate, Richard Thaler.
So you call the new edition Conversation Between Past and the Present, and you have a co-author now who you earlier joked that is probably half your age. What have we learned, or maybe not learned, about human behavior? Tom Keene made the point earlier that humans are predictably irrational at their core.
Yeah, I don't particularly like the word irrational, but they don't behave the way rational economic models say they do. A simple example is something called the ultimatum game. I give Tom $100 and I say he's got to share it with you. He makes you an offer. You get to say yes or no. If you say no, you both get nothing. A rational economic model says Tom offers you $1 and you say $1 better than nothing and you take it. Real people, if he offers you $1, you throw it back at him. The way a cab driver in New York once did on a 975 ride, and I was in a hurry, and I said, "Keep the change," and he threw a quarter at me.
No.
So that's real people, and we need models of real people, and in any aspect of life.
It seems like behavioral economics has sort of gone mainstream. I hear that phrase at least tossed all around. But has it really changed policy or markets? Or do you see any real life example of that?
Sure. I mean, probably the biggest impact in policy is the design of retirement plans.
Yes.
So we were just, kids in the 80s when 401k type plans were coming along. And in the early days, many people didn't even join. And that's like the dumbest economic decision you can make. You're working for a company, they may be matching dollar for dollar, 6% of your income, and you don't join. That's crazy.
Peter Orszag leading on that now at Lazard. He's been very good.
Yeah, I worked with Peter on that back in the day.
Yeah.
And it took legislation to allow people to be automatically enrolled and to offer things like target date funds that we're all now used to. That took fighting a revolution.
In your foreword with Alex, you talk about the last chapter, the law of one price. What is the law of one price?
The law of one price says any asset has to sell for the same thing anywhere. If I try to buy 100 shares of IBM at Fidelity, it better be the same price as at Schwab. But sometimes we get examples that differ from that. And, I've had 30 years of discussions with my friend Gene Fama at Chicago about whether markets are efficient. I can't prove the stock market is too high or too low, but when I see the same asset selling for two different prices, even Gene has to say, well, yeah, no, that shouldn't happen.